Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Strike price categories, we have in, at, and out of the money options. So in the money options have the highest probability of expiring in the money. They're also the most expensive. Out of the money are the cheapest, lowest probability of expiring in the money. They have the lowest cost. And at the money is a balance between the two. In fact, I like to recommend when I'm teaching options that people get very confused on which strike price they should look at. I recommend that you always look at the at the money options. And then after you look at the at-the-money options, then you may want to look at the in-the-money options because you don't think the other one is going to make such a big move, or the out-of-the-money options because you do think it's going to make a big move. But you always will want to take a look at the at-the-money, and you could always take a look at all three, of course. Risk and reward, most important point in options, is the risk worth the reward? You don't really know, but again, you make a forecast, and then you're also considering the trade-offs and your leverage. So what's leverage? Leverage in physics is a factor by which a lever multiplies the force. So in finance, it's using resources in such a way that the potential positive or negative is magnified. Hence the phrase, leverage is a double-edged sword. Options require forecast. So options investments require forecast. When you're thinking about making a forecast, let me just use the example of the Australian dollar, just because the Australian dollar, the U.S. dollar divided by the Australian dollar, has been absolutely it's had an amazing run. The Australian dollar has sold off so far, which means the AUX has gone up so far. So AUX is 140.119. Let's just say we're looking at the 140 call right now. Well, you may think that the AUX is going to drop to 130. If you did, maybe you should be buying the 133 or the 134 put. If you think it's only going to get to 134.35, well, maybe you should be buying the 140 put. So there's different risk-reward propositions for all the different strike prices. So that's how you get leverage. The further out of the money that you buy, the more leverage you get. However, the lower the likelihood of success. So you want to remember that the extrinsic value is really made up of volatility and what's called the interest rate differential. For all of you that are trading FX spot, you understand that we have this interest rate differential. In fact, the interest rate differential narrowed a bit today because the Australian Central Bank actually cut interest rates a whole point today. So what do I need to choose, call or put? So you have to decide. You think the U.S. dollar is moving up, you'd be buying a call. If you think it's moving down, you'd be buying a put. Time frame, as I said, if you think something's going to happen in 2 months, buy a 3 or 4 month option. Don't buy a 1 month option if something's going to happen in 2 or 3 weeks. You're not giving yourself enough time. But again, that's up to you. Strike price, it's the different strike prices create different risk-reward propositions. Volatility forecast is embedded in every option. In fact, the volatility now was as low as about 10 or 11% for the U.S. dollar, Australian dollar, just about 5 or 6 months ago. Now it's about 28%. So obviously the market's expecting more movement. It's not a guarantee. However, well, that's the market. So the market's expecting a big move in the next couple of days, weeks, months. We'll see if it all plays out. It has been happening in the past. So what are some popular option strategies to try to avert this disaster? That's what we're trying to do. Trading the FX market, like any market, well, we want to avert disaster because just think of it this way. If you lose 50% of your account and they go, unfortunately, some of us are down that much, depending on the index you're in, the stocks you're in. If you've lost half your money, well, you're going to need to get a double on your money just to break even. So part of investing is actually trying not to lose that much money. So buying calls or puts, limit your risk. You could do debit spreads or credit spreads. Depending on your risk tolerances, you could buy volatility. which means that you're expecting movement. You're really not sure which way, and you could sell volatility by, let's say, doing iron condors, or you could buy some butterflies. Which strategy is best? There isn't any one best strategy. Initially, your market forecast is important. Then you have to consider your own risk tolerances and your own financial goals. All strategies work. They just don't work all the time. So slide 19, really important. Just remember that what this is trying to tell us is the most likely event is where the price is today. That's just based on a pricing model. The pricing model may not necessarily be correct. In fact, we realized that in the last 4 or 5 months, these pricing models have not been correct. And that gives us opportunities to trade. So we can see that the light blue tells us that we're going to have a 68% chance that it's going to stay in that light blue area based on statistics. 95% chance it'll stay within that light blue and dark blue area, and 99% chance it'll stay between the white, dark blue, and light blue. Well, I hate to say it, but I'm sure you all realize this. We've probably made more than a 3 standard deviation move in a lot of assets already this year. So something that should only happen once out of every 100 years is happening. That's why we need to trade with limited risk. In fact, that's why you should trade with limited risk all the time, because you really never know when these crazy markets are going to occur. The models are models trying to avert disaster. Really important point, averting disaster is understanding that you want to trade with limited risk. The option models make some assumptions that aren't 100% correct. If an investor has a different view than the options market, it could create a trading opportunity. If you think the pair is going to be moving up or down a lot, well, you may want to implement that view by buying simply a call or a put. If you think it's going to move up moderately, maybe it's a call spread. If you think there's going to be a major move, you're not sure which way, well, buy volatility. Buy both calls and puts. Oh, by the way, LIBOR, the London interbank rate, offered rate, unbelievable. As you can see, it's off the charts here the last couple of years. It's trading at a new high. They've been keeping track of this for the last 20-something years. And the LIBOR rate is really the rate that, let's say, Bank A will lend to Bank B. So this was all working out really well until September 1, or maybe September 5th or whatever. After that, you could see that the market just broke down. The market broke down because no one trusts each other any longer. And, yes, TED spreads also off the charts. LIBOR, TED spreads. These are all things that sort of tell you when these pricing models aren't a great way to look at things. Or if they are, it's really a way to understand why volatility is as high as it is. Because when things are happening that nobody could really expect, that's when volatility is really playing its greatest impact. And that's, of course, the market we're in today. Probability of change theory says the asset is just as likely to move up or down. Volatility forecasts tell us by how much. So we can actually turn that curve to the side, and no matter what you're thinking, the probability for tomorrow's price action, even though we've seen the market sell off, believe it or not, the likelihood of the market moving up or down tomorrow is 50%. Most of us probably don't believe that, but at least theoretically that's the case.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.